First, I'd like to introduce Bill Wilt. Bill has a 30-year career in insurance. So in other words, he's a young guy that has spanned many roles. Those include executive insurance positions, equity and credit analysis, actuarial consulting. It's this incredibly varied background that Bill is able to sort of consolidate and bring to bear on important industry issues. And I think you'll see that very much in evidence today. Along with Bill is his partner at Assured Research, Alan Zimmerman. Alan himself has a long and distinguished record as an insurance analyst and finance person. He was named to Institutional Investors All-American Research Team. Most recently, he had been, prior to Assured Research, had been at Macquarie and the director of research at their predecessor firm, Fox Pitt Kelton. And I'm old enough to remember Fox Pitt Kelton pretty well. So that's certainly a distinguished thing to have on your resume. So without further ado, let Bill and Alan introduce you to this topic of social inflation. And try not to be too scared by it. I mean, we in the industry have been through this before. Sadly, though, it seems like we may be in it again. Bill?
In the soup. Hey, Ed, thanks so much. Are you able to hear me?
Perfectly. Thank you.
Oh, good. Okay, good. And Alan, are you on the line as well?
I am on. I'm just trying to get my video set up.
Oh, okay. We can see you now.
If you don't see me, it's not a big deal.
We can see you. So good.
Okay.
So Ed, shall I go ahead and I'm going to share my screen?
Absolutely.
I think is the game plan.
As they say, my job is done, and I'm sure everybody's glad of that. Go ahead.
Well, don't go far because I am not a Zoom expert, but I will share. And my guess is now that you're going to be able to, you'll tell me that you can see the screen, and I'm just going to hit the slideshow here. I appreciated, by the way, your kind words by way of introduction, and thanks so much to you and your colleagues at the CPCU for inviting us to speak today. It is our pleasure. We are coming at you, both Alan and myself, from the other coast. We are both in northern New Jersey. And I, for one, found the Arity presentation to be fascinating and very enjoyable. I interpreted it, as many of you probably did, through the lens of what you see or what you experience every day in your commutes or lack of commutes, and all very interesting. I only wish that we had the technical skills to create a presentation that was as visually as appealing, but alas, we do not. But hopefully you'll find this, and I do think you'll find this to be interesting. Quick, by way of just a background about Assured Research. We touch insurers, reinsurers, brokers who control about $175 billion in premiums as our subscribers. And in addition to our subscription work, which I'll just mention briefly, if any of you, after seeing this, want to learn a little bit more, or reach out, get some of our research on a trial basis, please, you'll have plenty of ways to reach us, including at the website that you see there. But we also offer educational presentations to subscribers. So that's a part of what we do. And last, I'll just mention that we do touch the investment community through our work. We are not traditional Wall Street analysts any longer, but we maintain a dialogue with them and send some of our research to them. And of course, they inform us too about what's happening in the industry and what they view as important. Ed gave our background, so I won't add really much other than you see there the ways to contact us. So please feel free to reach out if you're so inclined. And with that, let's talk about social inflation. Here are the topics that we're going to cover today. I'm going to do a bunch of the heavy lifting and invite Alan in for his commentary and observations throughout, but then he does have a few sections as well. Now, what is social inflation first, and when did it become a topic of conversation? Um, Early 2017 is the answer to the latter question. Um, we monitor the industry closely. It's what we do. We're industry analysts, and we started writing about the topic in early 2017. We've titled most of our research notes "Social Inflation is Back," but I can tell you that, and I can tell you, I should say that in the last 3 years, it's easily been probably our most requested topic for meetings like this, presentations and in person when you could back when you could do that, requests for our research and so forth. It's clearly on the minds of industry professionals is the point that I want to make. And if you had asked us 3 years ago, what was the purpose of our research? What were we trying to accomplish? We would have told you that we were trying to quantify social inflation, and realize, and with the passage of just a bit of time, we realized that that's a bit too bold. It's quantifying this is really very difficult, and the real thrust of our research, I think, is more appropriately described as trying to find objective signals of social inflation in the economy, and that's really what we endeavor to do. Let's keep moving forward, and I promise you we're going to try to do our best to define social inflation soon. But addressing the elephant in the room, to make sure that we do. COVID-19 litigation. What's going to happen with COVID-19 litigation and social inflation? And sadly, I think we are of the view that the two of those trends are going to conflate. They're going to merge and magnify one another. We are not, by the way, just we try, even though it pays an insurance to be, to view the glass half empty more often than not. It has been my experience, at least over the years. We really do try to see the glass half full and look forward positively where we can. So this isn't for us just a steady drumbeat of negative news and negative information and always thinking the worst. For reasons that we'll get into in the presentation, income inequality being one of them, third-party litigation financing. There are some really concerning trends that I think the property casualty industry is going to be contending with for the next few years. So as to COVID-19 litigation, we think that as the economy reopens and the courts reopen and kind of the wheels of the legal machinery are greased a bit more than they are right now, that you're going to see these two trends conflate. And in a few years from now, I don't think actuaries will be worried too much about whether something, a trend predated COVID-19 or is COVID-19 specific. The issue is that they're two are going to magnify one another. So that was a lot of discussion without actually first trying to take a stab at defining social inflation. So we offer that here, and realizing that there are hundreds, I guess, of insurance professionals on the call here as I speak. Probably we would all have at least a slightly different definition of social inflation if we were asked. But the common refrain, you all have heard this saying, hey, I may not know how to define something, but I'll know it when I see it. And I can tell you as an actuary that that's actually, you'll hear something like that mentioned very derisively, if I'm pronouncing that correctly, by a management team. They'll say, gee, my actuaries, see something once and it's interesting. They see something, a second time and it's maybe an issue to be watched. And then by the third time they see it, they call it a trend. But by then I've already sold 3 years of underpriced liability policies. And that little vignette is kind of what we're getting at here, is that, while it may be understandable that, we don't quite know what social inflation is, but we think we know it when we'll see it, unless you try to be a bit more proactive than that, you're not going to be doing well by your company, because you will have, by the time it's recognized and brought into the pricing indications and so forth, you will have sold a few years worth of underpriced, in particular, liability policies. So that's why we're doing what we're doing. We're trying to find objective signals of social inflation. So what might social inflation look like? Well, to an actuary, it might look something like this. Now, we're not going to overthink or overanalyze this actuarial loss development triangle, but I can just give you, a quick orientation. First, green is good and red is bad, as you might guess. And where the definition, the delineation of red versus green is if you look down the individual columns, if a number, and these are incremental loss ratios, this is for commercial auto liability. Pardon me. So for accident year 2005, if you look at the upper left-hand corner, accident year 2005, as at year end 2005, the loss ratio for this this is the industry commercial auto liability reported paid plus case loss ratio of 34%. And another during the next 12 months, calendar year 2006, on accident year 2005, an additional 11 points of loss ratio points came in, so on and so forth. When you look down the development column, we're taking an average and saying if the loss ratio is higher than average, it's red. If it's lower than average, it's green. And I can just tell you this, what you would like to see if you're an actuary, you'd like to see a smattering of red and green with no real pattern. And you do see that in some cases. If I were showing the homeowners loss ratio here, you'd see randomness. Actuaries like that randomness. It means there's a central estimate with some random variability around it, and they can make their loss development projections. When you see big blotches of red here, it tells you that there is something going on. Again, we won't overthink it beyond that. Clearly in commercial auto, there's underpricing going on, but there's also issues pertaining to nuclear verdicts that are starting to hit and influence the loss ratios. So this is an example of what social inflation might look like to an actuary. We define social inflation. We put in inflation broadly. If you look in the right-hand side here, really in three buckets. The first is inflation to measure stuff, and it can be stuff that's relevant for insurers: lumber for rebuilding homes, home prices; concrete for commercial buildings; sheet metal for repairing autos. The point being, especially for actuaries, there are materials, there are indices that can be external indices brought to bear. You'll understand how prices are changing. Similarly, with the second bucket, which would put as medical inflation. So medical related matters, clearly important for auto bodily injury, for workers' compensation. Again, while there might not be a perfect external medical index, we could all agree that you can track medical inflation through various indices, not too hard. The third bucket is the type of inflation that impacts particularly liability claims for property casualty insurers, is really everything else. It's the third amorphous bucket into which you would put social inflation. So to try to be specific, it captures the increased propensity of people to sue, rising jury awards that seem to be separating from kind of the economic foundation of what a claim might be worth from an economic perspective, expanding judicial theories and courts that are expanding, as lawyers might say, beyond the four corners of a contract. It's any and all those things. So what we have been trying to do, if we're going on, are entering our fourth year now, and what we're sharing with you today is our efforts to try to find signals of social inflation, objective signals of social inflation in the economy, like legal trends, like judicial appointments, trends in third-party litigation financing, and importantly, we think measures of inequality. So that's really what we have for you here as we look through these next handful of segments is what are those objective signals? What are we looking for? And what
Bill,
are
let
we
me just cut
seeing?
in. Bill, let me
Yeah,
just cut in for a
please,
second
Alan,
because I've been
go for it.
monitoring the questions. And
Okay.
it was a good question just for definition. And the question was, what is a nuclear verdict? You used that phrase. And
Oh, good.
I'll give you my definition. Maybe you could expand on it. The nuclear verdict is something that's so out of what was expected, without giving a specific example. Think of, somebody suing for $10 million and the jury comes back and awards 100 or something like that. And what Bill was getting at is we're seeing more and more of those. And I think that's the way to think about a nuclear verdict. Bill, do you want to add to that before you go on?
No, I think you captured it well. You described it relative to expectations, and I would just share that, for instance, I think I used it in the context of commercial auto. $5 and $10 million are numbers that you'll hear frequently. That thresholds above which somebody might say, "Hey, that's a nuclear verdict." And again, kind of keeping with Alan's theme, which is the right one, I think, of defining it relative to expectations. It's just this breakage between an individual being harmed and being able to look at and kind of roughly quantify his or her physical damages and other negative implications for their life. You might get to one answer, one order of magnitude, maybe low millions, and then the verdict that comes back is just some multiple of that. So again, it's back to this idea of it's a multiple of kind of what you might reasonably expect as a verdict or a settlement. So good. Thank you for that, Alan. And do that again, please, if something relevant pops up. So we're looking at legal trends now, objective measures of social inflation in the economy. And what I can tell you on these next couple of slides is that you'll see, if you look in the 2015 to 2016 timeframe, you see an inflection point. You see something start to change. So it's probably not a coincidence that we started researching in early 2017. Started researching social inflation. Not that we're saw it clearly at that point. We would have been reacting to our monitoring of what insurance management teams were saying. And my guess would have been that in the third and fourth quarter of 2016, you started to hear insurance management teams talk about rising verdicts, explaining why their loss ratio in a particular line of insurance was higher than analysts were expecting because they had some adverse jury verdicts, things of that nature. So it's interesting that, that we started picking up those threads of information in that time frame, and then with the benefit of some hindsight, you look back and you say, "Gee, in 2015, on the left, torts, so allegations of negligence across, it says 17 states that represent about a third of liability premiums." And then more broadly, when you look at all civil cases, which would be a bit too broad, realistically, because there you get in tax issues and all other matters. But nevertheless, you see that that inflection point. And you get it again here. I'll add that one of the things we at Assured Research really like to do is to try to find disparate sources of information and bring them to bear on property casualty insurance. It's a challenge to get legal information at the state level. It can be done. We've got an associate who's proven to be quite good at it over the years, but nevertheless, it ain't easy. Here we have, but for big states, we can all agree, big and important states, that we were able to delve into. And there you see it again, not huge, but you see an inflection point. And that kind of occurs over and over again here, thanks to TransRe, an article that was made available. Information is a bit dated now. We'd love to get 2019 added onto that. But again, for purposes of looking back, the point is, hey, in 2014 here, but 15, 16, you began to see things change. You saw jury verdicts start to rise. And here, these are medical professional verdicts. And in this article, as I recall, where they looked at verdicts by size of verdict, less than 10 million, 10 to 25, over 25 million. All of them saw increases in severity. And I'll mention, somebody might rightfully say, "Gee, but aren't jury verdicts really just a small percentage of the overall settlements or claim payments that take place?" And the answer to that is yes, they absolutely are. But they carry an outsized influence over settlements. They really, jury verdicts really raise or lower the bar against which other similar cases will look to and say, hey, gee, if that life was worth, $5 million, there's no reason my client's life wouldn't be worth, every penny as much, if not more. So you see, my point is that these things feed off of one another. And then the last slide I'll show you here again, thanks to, in this case, Advisen. Again, inflection point somewhere in the 15-16 timeframe, and you see the escalation from there. We, by the way, if I don't mention it, I'm sure I will, but hold me to it. We'll offer some explanations of why we think this has been happening as we go forward. But I want to keep you engaged here and keep an element of drama in the presentation. This is an interesting slide. We think, again, we're still focused on the legal system. Other sidebar commentary, we also like Assured Research to look back over long periods of time when we can, disparate sources of information viewed over a long period of time to try to inform and see these longer term societal trends in this case. And here you see a very interesting relationship between the liability combined ratio. So this is nationwide U.S. Insurers liability, general product, and I think even medical combined. So all liability, the combined ratio, that's the bars. And then the red line that you see are federal tort cases. Now, state courts matter more to insurers than federal courts, but federal courts are not unimportant. And the nice thing is we can, through the U.S. Attorney's Office, get data. This actually goes back to 1973. When you put this together and you overlay recessions, the major ones that you see there in the early 80s, the early 90s, of course, we all remember the great financial recession. You see a couple things. Tort cases tend to spike in the years after a recession. And through like 1995, there was actually a very high correlation between tort filings and the liability combined ratio. That's broken down somewhat over the last 2 decades, but nevertheless, it's still interesting, in particular, to observe that there's this spike in tort filings after a recession. And again, we think that's kind of part and parcel of the social aspect of social inflation and human behavior. Alan, I'm going to turn it to you to talk about multi-district litigation.
Yeah, thanks. Just to continue on the legal system without getting overly bogged down in it. We watch the trends in multi-district litigation, and these aren't a lot of cases, but they're the bigger cases, and they're the ones that get a lot of national attention, and therefore they have a psychological influence on a lot of other cases. And so we'd say it would put it in a sort of good news and bad news category. I mean, the first news, and I'll show you some slides on this, the overall MDL cases are down 36% in the last 8 years, which is good news. The less good news is that the products liability cases, which are the bigger dollar ones, are only down 18%. And the really bad news is that the number of large cases is up significantly. Bill, if you go to the next slide, I'll show you what I mean. First of all, I mean, here is just to think about what's in the multi-district litigation. I mean, products liability is by far the biggest category. And the other categories are, without getting over, are antitrust and intellectual property and various other things. But products liability is the biggest, and as I said, that's where the bigger dollars are. So that's why we watch that one more closely than the others. So here's what I was getting at. If you look at the change, the change is definitely down, and that's what the left-hand slide is showing, and that's good news. But the right-hand little bar is the really bad news. I mean, you can see that the number of claimants in the large suits is just going up, and part of that, there are 1 or 2 big cases running through the system, but it's still an interesting trend that the number of large cases is going up as a percentage of the total, and the cases are getting much bigger. So I think that's, Bill will talk a little bit about advertising and how attorneys are getting clients in, but I think this is a clear documentation that the number of claimants in these suits are going up fairly dramatically. Bill?
Yeah, thank you, Alan. I'm going to draw a parallel to a comment Ed made with regard to the last presentation. And Alan, you can check me if you agree on this. Alan, if you weren't, I think you were probably listening, but if you weren't, Ed made the point, in his early rate making days at an auto insurance company, going back, a few years ago, that it was, pencil and paper and a calculator and, at the time, cutting edge at the time. But when you compare that to the technology that can be brought to bear to auto insurance and analyzing driving behavior and so forth today, it's really night and day. And I'll just throwing it out there, I would guess that the ways in which attorneys contacted potential claimants, informed them about their their rights, and I'm putting those in quotes, although these guys do some social good, so I don't want to come across as too biased here. But the ways in which attorneys and the legal profession would have been able to contact claimants, draw in potential claimants, comparing that 15 or 20 years ago, even maybe 10 years ago to today, I would guess you would draw that same kind of night and day comparison. Do you agree with that?
Well, I mean, I think years ago you had to watch television at 3 o'clock in the morning to see an ad for a claim, and now we have
That's
to
right.
turn on your computer.
Right. Yeah, that's
And in fact,
exactly right.
we've tested that. We've put in some some big claim or some big issues, like either opioids or things like that, and we've just put it into the computer, and all of a sudden you start getting things from law firms saying, can we help you? Can we help you? Can we help you?
Yeah.
So no, the way they contact people is, in fact, I'll tell just a ramble for 2 seconds. I'll tell a
Please.
story that, sort of off of social inflation, but this will make you laugh, the people listening. We are doing a lot of research on this whole issue of church sex abuse, and because we think it's a big issue for the insurance industry, and I do a lot of the research, and so I'm constantly reading court cases and things like that. I can't turn on my computer without a law firm asking me if I have a sex abuse problem. I'm always trying to find an autonomous computer to do the research on to get rid of these guys.
Yeah. No doubt.
Okay, move on. I didn't mean to get off on that, but I think that demonstrates your point that it is so easy to reach people now. It's really changed dramatically.
And they're very sophisticated about it in the way it's done. So we'll get to advertising shortly. Again, remembering we're looking for objective signals of social inflation in relevant parts of the economy, and with ultimately our goal is to help underwriters, claims professionals, actuaries identify these trends early, know what to look for, customize them to their own particular insurance company, and geographies, and improve upon what we're able to do. So we talked about legal trends and statewide trends over time. Let's look at the judiciary. Not a lot of slides here. I've taken a few out and being mindful of the time. But I do want to make this point. This is an area where I think we feel like we've done a fair amount of research, talked to a lot of claims professionals, many senior claims professionals or lawyers in their training. We've talked to a number of general counsels at insurance companies. And come to the conclusion time and time again throughout virtually all these conversations, that state courts matter more to insurers than federal courts. And I'll just repeat that just to drive it home. State courts matter more to insurance companies, particularly with regard to the bread and butter claim issues, coverage issues. They matter more than federal courts. And the reason we're going there is because shortly after the 2016 election, and I'm admittedly playing just political stereotypes here, but I think these are prevalent throughout the industry. We were sitting, Alan and I, with a smart investor, an individual who'd been in the business of investing in property casualty insurers for decades, and he said, we've got a change in administration now. We're going to have, a return to the appointment of judges who live within the four corners of contracts, who are pro-business. Everything's going to be okay. I'm embellishing a little bit, but that was his broader point, was like, hey, there's going to be a change in administration. more pro-business, everything is going to get better. And I've heard that multiple times over the years, which is why we reacted to it. We said, I don't think it's that easy. And that really kicked off this strand of the social inflation research, the conversations I described to you, where we came to the conclusion, have come to the conclusion, that state courts matter more to insurers than federal courts. We all know, and there ain't nobody on this call who doesn't know, that federal judges, Supreme Court justices, are appointed for a lifetime. But that matters a lot, the federal appointment, because that means that those judges go through multiple political cycles. In fact, when maybe a year ago or so, I think, or maybe it was earlier this year, the last federal judge appointed by President Lyndon B. Johnson just passed away, and
the end of 2019. Yeah.
Okay, so just almost a year ago, and incredible. Now, so let's move forward. I don't want to say politics don't matter. They do. Our advice to insurance companies listening, anytime we're talking to actuarial groups, claims professionals, business development folks, we say, hey, look, if you are thinking about expanding liability policies in a new state, a new region of the country, appointing agents, issuing new policies and products, the political climate absolutely does matter, and you should be aware of it, and you should think about it. But it takes a while to change at the federal level, and even at the state level, although maybe you could say virtually all state judges are ultimately elected or appointed through some political process. Our work has shown they tend to keep their seats for 6 to 10 years, even a little bit longer. So it's not a lifetime, but it's a length of time that may go through political cycles. So it's an important underwriting consideration. We absolutely advocate for people, insurance professionals, thinking about it, but it's just not that. It's not this sudden switch when after an election that some professionals may think it is. Let's move now to third-party litigation finance, which is clearly the one trend that, I would say this, Alan, tell me if you agree with this. I would say, and I'm going to get a tiny bit ahead of myself, but nevertheless, you ask 10 insurance professionals, hey, what's the root cause of social inflation? Maybe you gave them multiple choice that included third-party litigation finance and wealth and income and wealth inequality. My guess is that people would check the third-party litigation finance box over the wealth inequality box by a factor of 2 or 3 to 1. I think most people think third-party litigation finance is really one of the root causes. We're going to make the case. I'm going to make the case that that may be a bit more balanced than people realize, but clearly third-party litigation finance is important. It's changing and has changed the economics of the legal profession. You see here Burford Capital being one of the few, 2 or 3, I think, publicly traded third-party litigation finance firms. Their assets under management, their ability to invest in either individual lawsuits to maybe back complex tort law, like some of the multi-district litigation, some of the product liability cases that Alan showed earlier, or their ability to simply invest in law firms and back a portfolio of cases. It's magnified. It's grown exponentially just since 2015, as you see there. It's probably not a coincidence that in 2015, 2016, 2017, you remember in the legal slides that we were showing, you saw that uptick in frequency of lawsuits and the severity of lawsuits. Some of that clearly, I think, we think is from third-party litigation financing. What is it? It's really, you don't have to overthink it. It's just the ability of third-party investors through an investment in Burford Capital to in turn invest in, as I said, individual lawsuits where, if the firm they're backing wins, typically the plaintiff or the plaintiff wins, then they'll get a percentage of the winnings to back portfolios of cases, maybe tort or product liability cases, or to invest in law firms. and it really has changed the economics for law firms. If you think of a traditional partnership where they pay out a big chunk of money at the end of each year to their partners, this allows them, provides them a buffer to use as an economic buffer to use as working capital to advertise for clients, to invest in the research on new types of lawsuits, to hire real expert witnesses, to do proper diligence of claims, and makes it really has made the plaintiff side of the plaintiffs versus defense industries a lot smarter, a lot better resourced over this last few years. Now, all this being said, it's probably worth just sharing with you that there are three different kinds. At least this is work from Rand, I believe, that kind of lent this idea of three distinct kinds of litigation finance firms. Commercial litigation finance, which is, I believe, is the category Burford Capital would slot themselves into, and that we would. I will say that their main focus, not to say they're not involved in some traditional tort cases, mass product liability cases, but a lot of their work is focused on rather esoteric business to business litigation, patent infringement, intellectual property matters, and so forth. So not bread and butter, slip and fall issues where the propensity of somebody to sue has been changed. Consumer litigation finance you can think of as companies, you're driving down the highway and you see a billboard saying, "Were you injured in a lawsuit? We can advance your daily living needs." Or, "Were you injured in an accident? We can advance your daily living needs." Law Cash is one that comes immediately to mind. When you see the "Not Us," it means we've spoken with the heads of some of those organizations, with their umbrella groups, their trade groups. They all say, "Hey, look, here's our business model. We're not the ones driving this real social inflation." There is another class of specialty finance firms that is probably a much more likely culprit, and we don't have the time for it, but I'm just going to point out that this Advocate Capital, that's a hyperlink that you can use. You'll get these slides through the CPCU Society, and click on that, or just go to it independently, Advocate Capital Inc. And if you go to an About Us, where you might find it, there's maybe a 3 or 4 minute video that they explain, "Hey, here's what we do," and a lot of you, if you're like us, will have a light bulb go off because, and here's a quote from one of their professionals saying, "We're a game changer for contingency fee law firms. We give them the confidence to go into negotiations and reject low settlement offers." And again, that if you read between the lines somewhat, that tells you that there's the economics of law firms are being changed because they have these financial backers that simply weren't there when they were just more traditional partnerships. They're providing them the working capital that they need to do all this research on claims, to invest a lot of money, to gather claimants through smart social media means, and to be aggressive in their pursuit of a settlement. That working capital also means that the plaintiffs' firms, have money to advertise. And what you see here is the year-on-year advertising. This is through television, which is still the main channel for law firms reaching individuals. But you see the year-on-year change in both the number of ads, which we've been told is the better metric to watch, the number of ads, and in the ad spending. 2019 number of ads were up 16% year-on-year. This data point warrants refreshing, but we've annualized the year-to-date April number, and it was flat with 2019. Flat doesn't sound particularly impressive, but at least going back into the let's say the midsummer timeframe, advertising broadly across the U.S. because of for obvious reasons, the pandemic, was down in the double digits, or like in the teens, I should say, down 13% is the number that sticks out. So if legal ads are staying flattish and everything else, beer, pizza, and everything else is going down by 13-ish%, the voice of lawyers and plaintiff firms soliciting claimants is rising. So, Alan, I know you had a few comments. Am I remembering correctly that you wanted to share on some of these trends?
Well, I think I want to make a comment on just litigation. I think the one thing we have found very clearly in our research is that the plaintiffs firms, in part because they have these resources, are getting more and more sophisticated. They're doing a lot more jury research. I mean, you and I know we've talked to jury consultants who are very sophisticated in developing stories that will resonate with juries. And so you've got, on one hand, you've got the plaintiffs firms getting more and more sophisticated. But when we go back and look at the legal spend in the insurance industry, it's going down, or it's going down as a percentage of premiums. And I think I think that could be a classic example of, penny wide, pound foolish, or whatever the comment is. Spending less money on litigation or on legal issues when your opponents are ramping up just doesn't seem like a long-term good strategy. And I think part of it is, without getting into the mindset of managements of insurance companies, I think to the extent you see your court general counsel office as being a cost center, you're making a mistake. I mean, you really should be spending more to fight off with what your adversaries are doing.
Yeah, good. Thank you. I'm glad you said that, and because I agree completely. And it gets to me as an actuary by background. You're an analyst, and a long time ago, and an accountant by background. We're data people, and I'm speaking. Probably many of us, most of us in the insurance industry are people who focus on data. You've already shared, kind of one of the things that we like to do is look for disparate sources of data with long time series and bring them to bear on insurance. That's all well and good. It's important and it's necessary, and we hope we add value. But I think it misses sometimes the first word in the term social inflation, and that's social. That some of these trends are truly societal in nature, and inequality is one of those. This underscores it probably more than anything, I would guess. Here is a comment by one of the litigation consultants that Alan mentioned that we have been fortunate enough to be introduced to and learn from. And here's a quote, if you haven't read it already, just to highlight it. In the years that followed the financial crisis of 2008, we, the jury consultants, observed a trend away from concerns over harms of frivolous lawsuits. Some of you may remember in the early 2000s, a lot of concern over frivolous lawsuits, companies pulling products from shelves because in certain states because they knew they were getting sued, and they wanted to lessen their exposures. That led to tort reforms that were beneficial. We moved away from that after the financial crisis toward this view that and this concern over unbridled corporate influence and power, and corrupt executives, and this really anti-corporate behavior, as they point out. This is them, not us speaking. That's become the norm. There's a real loss of trust that's been reflected in the deliberation room. Point out again, jury verdicts may be a very small percentage of total claims, but they have an outsized influence over the actual settlements. We think, and I think these consultants would agree, that that inequality is an important aspect of that across society. And let's not make this a political discussion. We're just going to stick to the facts, ma'am. For example, what you see here, new data from the Federal Reserve brings us through the second quarter. Everything's with the government has a bit of a lag, but you look at this is household net worth by the top 1% of households. The next 9% gets you to the top 10. The next 40 gets you down to the 50th percentile, and then those in the bottom 50. Thing that jumps out at me is that you can barely see the household net worth of the bottom 50%. In fact, to really illustrate it, you would need to get it on a separate scale. When you, if you look at this, I'll go back briefly, to my eye, you might say, okay, well, the top, the top 50% though, at least are growing kind of sort of at the same rate, kind of looks like. The scale is deceiving because this shows the top 10% compared to the next 40%, and the household net worth of the top 10% has grown, appreciably higher than, on a recurring annual basis over the last 15 years. than the next 40%. So the wealth inequality is worsening. And this is an acceleration. I think the view we have of a trend that's been in place for a long time. On the left here, this is now we've moved from wealth to income. When you look at income levels, this is the top 10% versus the bottom 90%. You see this divergence starting somewhere in the mid 80s, and then when you index it, it's a little bit easier on the right hand side. It confirms that somewhere in the mid 80s, the income levels of the top 10% really started to accelerate relative to those at the bottom. Corporate, attitudes toward corporations. Look at these two this measure of national income, and you have wage in the blue and corporate profits as a percentage of national income in the red. And look at the trends. Corporate profits as a percentage of national income are rising. Some variation, of course, and wages are really stagnating. And in fact, Alan, we were just talking before this that this can be updated now this is a much greater lag to 2019, but 2019, you look, it hasn't changed very much if I'm remembering correctly. There's a debate about, okay, well, corporate profits are up, then, everybody's invested in the stock market. And so that, wages may be stagnating, but if corporate profits are up, then we all benefit from the stock market. And the answer is some of us do, but not everybody. Only about a little over half of Americans own stocks, 55%, down from 62% before the financial crisis. So, it would be a little too glib to say, well, wages are stagnating, but we all benefit from a rising stock market. Not everybody. And all this matters because there is this interesting relationship, an inverse relationship between liability loss ratios and, in this case, wages, the real wages, or adjusting for inflation. I acknowledge you when you first look at this, it may be it's not obvious what's going on. So just let's look at what's the interpretation that comes from staring at it for a bit and doing some work with the data. With no lag between real wages and the liability loss ratio, there's an inverse relationship of 53%, a 53% correlation. So real wages go up, they get better, people feeling better, they're maybe less likely to sue, and liability loss ratio gets better. And the reverse is true. Liability loss, if wages stagnate or go down, the liability loss ratio gets a bit worse. Maybe people are more likely to sue. Maybe the juries are a little bit more angry, which is one of the leading issues that leading to these nuclear verdicts. When you lag the data by a bit, which you would kind of expect, and people don't know instantaneously that their wage has gotten better or gotten worse, in any given day or quarter, but over the course of a year or two, they will start to feel it in their pockets. The correlation goes up or improves with a 2-year lag. The bottom line I'd leave you with is that the real wage index is really a decent indicator of what's happening with the liability combined ratio. We think, and again, it's not just us. We've talked to a lot of experts, lawyers who work in the courtrooms, and these litigation consultants. Through this wage inequality, this is a real issue in terms of how juries and society view corporations. I'll just mention that 2020, the data is starting to come in. It looks screwy. We've got to, like everything with this pandemic, it's kind of messed with the data. So we've got to look at that more over time. But with that, why don't we go to one of the last topics, to Alan, on tort reform and what might actually stop social inflation.
Yeah, I want to get to that, but I want to add a couple of points to what you said, Bill. I mean, because we all tend to be data driven, we look at these inequality numbers and think of it in financial terms, which is a key part of it. But I think it's important to focus on the fact that there's been a sort of non-numeric social change too gone on, and it really goes back over the last 40 years or so. I mean, if you go back years ago, you used to think of three classes of society. I mean, upper class, middle class, lower class, and they were fairly clear cut. But the key that was important is that there was a lot of mobility within the classes. There was a tremendous amount of upward mobility, and no matter where you fit into the spectrum, you felt things could get better. You would get better. Your life could get better. Your kids' life would get better. And now a lot of the change that's gone on is sort of bringing that to an end, and that the distinctions in society have gone from sort of income oriented to class orientation. That might not be the right word, but that there's a view that there's sort of an elite, college educated, professional, maybe even coastal class of people, and then there's all the rest of the world, and the rest of the world people feel looked down on, and that is excuse me, in addition to excuse me, in addition to the numerical numbers, is sort of fueling this jury anger, which is sort of prompting all of this. And this isn't a political discussion, but there you can see the change in the politics. I mean, I'll give you numbers that I find staggering, and obviously I'll have to update them 2 weeks from now. If you look at the 50 wealthiest congressional districts, so the 50 wealthiest out of the 435 congressional districts, 41 of the 50 are Democratic controlled. And that's not the stereotype you have. You tend to think of upper class, higher income is in the old days, a Republican, because when you go back to the 1980s and you try and you can't quite match up to 50 because the districts have changed, but it clearly was 50-50 split. There wasn't 41 and 9. So I think there is there's another element of that besides the numerical part of it. So just wrapping up, I just want to make one quick point that we do a lot of work on the social inflation, and we keep asking ourselves, what's going to stop it? The answer is we don't know, but we do know what's not going to stop it, and we sort of compare that to the past. And what stopped the social inflation problem in the 80s, quite simply, was tort reform, and that you can see the data, and that's 5 years between 1985 and 1990. 39 states passed tort reform laws, and that literally changed the complexion of the industry. But just to show you how significant social inflation was, this is a cover from a March 1986 Time magazine. So think about what we're getting at. Now we're talking about a problem that sort of is within the law firms and for the insurance companies. This was a societal problem. I mean, big enough to reach the cover of Time magazine. So our view is, and then I'll stop. I'll just do this quickly. Tort reform isn't going to happen now. And one thing is, losses aren't that bad. The states that are the real serious problems aren't suffering economically like they were in the 80s. And basically, this may change, but there's no political will to tort reform fights now. So a couple good charts, and then I'll turn it back to Bill. I mean, here's the data on the 39 states passing tort reform, but look what happened to industry losses. I mean, literally, as this tort reform was going on, losses ended. Okay, and then if you look at where we are now, I'll show you 2 slides on that. The industry loss ratio was the combined ratio is 50 points better than it was. Nobody's saying, hey, look, I got a serious problem. Whereas in 1980s that we did. And the other part, just to say that things aren't that bad, is that the industry return on equity isn't particularly good right now, but the cost of capital is down too. I mean, so if you look at that black dot here, what we're trying to do is compare the difference between the industry return and the cost of capital, over different cycles. And if you look at how bad things were in the 1980s, we're not anywhere near that. So there aren't a lot of things that are going to stop this right now. And just as a final point, and then Billy, you can take over. I mean, if you look at the states, that the different groups rate states between the best legal environment and the worst, which goes by the name of the hellholes. If you look at the economic growth in those states, that the hellholes are actually doing a little bit better. So I mean, if you're a politician within those states, whereas in 1980 you said, oh God, we've got to do something because all corporations are threatening to leave. That's not happening now. So just to try to make the point that we don't know what's going to stop social inflation, but we do know that it's not going to be tort reform. And so to the extent that you're counting on that, yeah, you may be able to find within the 50 states some laws getting passed that limit suits, but it's not going to be a big trend like it was back in the 80s. Back to you, Bill.
Yeah, sure, Alan. I want to give you the appropriate shout out because I find this slide really very compelling, and you're the one who thought to put it together and look at the grouping states by legal environment using the sources that we have there, and then looking at their economic growth, because that to me immediately resonates. Just think about the pressures on a politician, as Alan pointed out, in the mid 1980s. If you're in a state where products are being pulled off the shelves because of the tort environment, and corporations are leaving, and that means jobs are leaving, you're compelled to change. You're compelled to do something, and contrast that with today. If you're in one of the hellhole states, you'd say, "Gee, the economy's doing very well," or it was historically through 2019. Thank you very much. So obviously, nobody's going to look great in 2020, and we'll have to sort that out. I will make this point. This is a small and short plug for research that's in our immediate pipeline. It'll be out next week. For our November assured briefing, we look at do a drill down on wealth inequality, and following on the lead of this work, we looked at measures of income inequality at the 10 best states on the left-hand side here, and in the hellhole states on the right-hand side. And what you see is appreciably more income inequality in hellhole states as compared to the states with the best legal environment. We don't have all the answers. We never do, but ask, I think, the right question, which is might it be the case that income inequality, to the extent that it's been persistent over time in these states, might it be the case that income inequality has led voting citizens to pick politicians who are more likely to pursue these, more activist, expansive, tort measures, and just pick politicians and create a legal environment that's more conducive to an activist type of plaintiff's bar. So interesting, I think, and as I say, in our pipeline. So that brings us to the end. Really, all we would want to share with insurance professionals, I guess, kind of by way of summary, is that unfortunately, we think this is all probably going to get worse before it gets better. It is not to say that we think we're anywhere back in the mid 1980s. Think about a couple of those charts Alan showed. Massive difference in the combined ratio and in liability. The liability line, returns on equity, not great, but they're not terrible. So we think things will get, as to social inflation, more likely to get worse from here, but we don't think the wheels are going to come off necessarily. We do think that COVID-19 litigation is going to conflate and kind of make these trends both worse and messier if you're trying to tease them out and separate them. Really, we feel pretty strongly that there's no real catalyst for tort reform. So I don't think that's going to be the savior that it was in the 1980s. Best course of action that we can muster for property casualty insurers is to just to underwrite, to price to the best of their capabilities, for actuaries to assume still fairly conservative loss reserve trends for these rising jury verdicts. And as those prices rise and they work their way into retail prices, perhaps they'll then be a catalyst for change and a reversal in some of these trends. So with that, why don't I stop sharing my screen? Ed or somebody can tell me whether you'd like us to take a few questions or just pass the torch. We're available for follow-up by email to anybody and everybody. So that's always an option.
Yeah, well, Bill, I think we've been passing the questions to you guys, and you've been handling them as the presentation went along.
Oh, good.
So,
okay.
Yeah.
Alan's
absolutely.
been busy.
Yeah, Alan has been busy. Absolutely. So,
good.
Well, I really appreciate this really thorough explanation for what's a really sobering topic, and I don't think it'll make any of us sleep better tonight, but hopefully it'll make us rate better and work better
There you have it.
as we figure out how to work through this. And I've got to tell everyone, I'm lucky enough to get some of the work from Assured Research, and certainly it informs me better than virtually any other source of information I get on the insurance industry. So, and after today's lecture, I'm sure you're not surprised by that.
Well, that's nice of you to say. We love what we do, and thanks to you for inviting us. And you all have looks like a very nice day lined up. So we will get out of your way and let you carry on with the rest of the agenda.
Well, thank you, and thank Alan ever so much. And
Okay, thanks.
yeah, that's great. One other thing I wanted to throw out there for all of you out here, that this talk was continuing education eligible. To get that credit, you're going to need to find that form out in the chat, launch it, complete it, and then submit it. And if you both listen to this this particular talk and then the one this afternoon that will also be continuing education eligible, you're going to need to fill out a form for each one. So with that, what I'd like to do is to pass the conversation over to Paul, and Paul will take us on to the next part of the next